Earning $100,000 a year in America is still widely perceived as doing well. It sounds like financial stability. It sounds like the middle class working as intended. But for a growing number of households, that income no longer delivers security, flexibility, or meaningful progress. In many parts of the country, it barely delivers stability. Here is the core problem. Income grew, but the cost structure of life grew faster and in a very specific way that most people failed to track. As a result, many households earning six figures are functionally middle class in name only. On paper, $100,000 seems strong. After federal income tax, payroll taxes, and state taxes, the take home pay is often closer to $70,000, $75,000, depending on location. That is roughly $5,800, $6,200 per month. From there, the math becomes uncomfortable. In large metro areas, median rent for a modest apartment can easily reach $2,500, $3,200 per month. Add utilities, internet, and insurance, and housing alone can consume 45 to 55% of net income. Financial planners traditionally considered anything above 30% a risk zone. That rule quietly broke years ago, but the consequences did not disappear. Then come the fixed costs that are no longer optional. Health insurance premiums, deductibles, and out-of-pocket costs often exceed $700, $1,000 per month for a family, even through an employer. Transportation, car payment, insurance, fuel, maintenance can add another $800, $200. Student loan payments for professionals frequently sit between $400, $900. Childcare, where applicable, can rival rent. Before groceries, savings, or emergencies, a $100,000 household can easily have $5,000, $500 in fixed monthly obligations. At that point, the margin for error is thin. One medical bill, one job interruption, one unexpected expense turns comfortable into fragile. Most people in this income range believe they are doing the right things. They followed the prescribed path: education, career advancement, stable employment, incremental raises. The mistake is not effort. The mistake is assuming that higher income automatically restores financial balance when the underlying cost structure has changed. Wages scaled linearly, costs scaled structurally. Housing, healthcare, education, and insurance did not just get more expensive, they became more rigid. These categories are difficult to reduce quickly without significant lifestyle disruption. That rigidity is what creates the feeling of being poor despite a high income. The data supports this shift. Surveys consistently show that a majority of Americans earning between $75,000 and $150,000 report living paycheck to paycheck. Emergency savings rates have declined, not because people stopped caring, but because surplus cash disappeared. Retirement contributions are often reduced to minimum employer matches, if that. The long-term consequence is not immediate collapse, it is stagnation. Net worth grows slowly or not at all. Risk tolerance drops. Career decisions become defensive rather than strategic. The household remains exposed to inflation, job market volatility, and policy changes. This is not a personal failure story. It is a structural mismatch between income expectations and modern expense realities. Understanding that mismatch, where the money actually goes, why it feels insufficient, and why traditional assumptions no longer hold, is the first step. Solutions exist, but they require a different framework than simply earn more. That framework starts by questioning what middle class actually means today, and whether income alone still defines it. To understand why a six-figure income feels insufficient, it is necessary to look beyond prices and into structure. The issue is not only that things cost more, it is how income is received, how expenses are locked in, and how most households manage cash flow without a system designed for this environment. First, consider income structure. Most middle-class professionals rely on a single primary source of income: salary. That income is taxed before it is received and adjusted slowly over time. Raises are usually annual, incremental, and often lag inflation. Bonuses, if they exist, are inconsistent. This means purchasing power reacts slowly while costs adjust immediately. Now contrast that with expense structure. The largest expenses, housing, healthcare, education, insurance, transportation, are contractual. They are paid monthly, rise regularly, and are difficult to renegotiate. When inflation or interest rates increase, these costs reprice faster than wages. The household absorbs the shock. Take a concrete example. A household earning $100,000 in 2019 rents a $2,000 apartment, pays $400 for a car loan, and contributes $800 monthly to savings and retirement combined. Over the next 4 years, rent increases to $800. Car replacement now costs $650 due to higher prices and interest rates. Health insurance premiums rise by $300. The household did not change lifestyle, but fixed expenses increased by $350 per month. Income, meanwhile, rose from $100,000 to $110,000. After tax, that might translate to an extra $500–600 per month. The gap is obvious. Savings disappear first, then flexibility. Eventually, debt fills the space. The second issue is behavior, but not in the moral sense often implied. Most people operate with a short-term optimization mindset. They budget month to month, not over decades. Decisions are made to maintain stability, not to build resilience. This leads to overcommitment to fixed costs because they feel manageable at the time of purchase. For example, housing decisions are often based on current income rather than stress tested against job loss, rate increases, or family changes. The same applies to car financing and subscription-based services. Each individual decision seems reasonable. The aggregate result is fragility. The third issue is the absence of a system. Many households earning high incomes still manage money informally. Bills are paid, accounts are balanced, but there is no explicit structure separating consumption, protection, and long-term capital building. Without that separation, savings become optional and are sacrificed under pressure. This is where standard advice fails. Phrases like cut back, budget better, or earn more assume flexibility that no longer exists. Cutting discretionary spending might free up $200–300 per month. That does not solve a $1,000 structural deficit. Earning more helps, but without changing the system, higher income often leads to higher fixed commitments. Another common recommendation, investing aggressively, also misses the point. Investing requires surplus cash and time. A household living near its financial edge cannot meaningfully compound. Market volatility becomes a source of stress rather than opportunity. The core problem is not ignorance or irresponsibility. It is that the financial playbook many people are following was written for a different cost structure and a different risk environment. Until income is aligned with flexibility and expenses are designed with resilience in mind, six figures will continue to feel small, not because it is, but because it is misallocated by default. The financial pressure experienced by many six-figure households is not random. It is the result of a small set of repeated decisions that compound over time. These decisions are common, socially reinforced, and rarely questioned. The problem is not income level. It is how income is converted into obligations. The first key mistake is optimizing lifestyle around peak income instead of durable income. Many households commit to housing, vehicles, and fixed expenses based on their best financial year. If a household earns $100,000, they often structure their life as if that income is guaranteed, stable, and immune to change. In reality, job transitions, health events, and economic cycles are normal over a 20-year horizon. The long-term consequence is exposure. If housing absorbs 45–50% of net income, even a temporary 10–15% income reduction forces trade-offs. Over 10 years, this leads to repeated disruptions, paused retirement contributions, reliance on credit, or liquidation of investments at unfavorable times. The second mistake is treating debt as a neutral tool rather than a risk multiplier. A $600 car payment at a 7% interest rate may seem manageable monthly, but over 5 years, it represents more than $36,000 in after-tax income. Add two vehicles and refinancing cycles, and transportation alone can consume the equivalent of a full year of net pay every decade. Over 20 years, households that maintain high fixed debt payments often delay investing by 5 to 10 years. Assuming a missed $500 monthly investment at a 6% annual return, the opportunity cost exceeds $230,000 over 30 years. This is not a budgeting issue. It is a structural allocation problem. The third mistake is assuming that employer systems provide sufficient protection. Many professionals rely entirely on employer health insurance, retirement plans, and job stability. When a job change occurs, coverage gaps appear. Retirement contributions are interrupted. Emergency funds are depleted faster than expected. A simple projection illustrates this. A household contributing 6% of a $100,000 salary to retirement invests $6,000 per year. If contributions pause for 5 years due to cash flow pressure, the lost principal is $30,000. At a modest 6% return over 25 years, that gap becomes roughly $130,000. The decision was not to stop investing permanently, but the consequence is permanent. The fourth mistake is confusing income growth with wealth growth. Income is temporary, wealth is durable. Many six-figure earners increase spending proportionally with income increases, leaving net worth growth flat. Over 10 years, two households earning the same income can diverge dramatically. Consider two earners making $100,000. One saves and invests $1,000 per month consistently. The other saves $200. After 15 years at a 6% return, the first household accumulates approximately $290,000. The second accumulates less than $60,000. Same income, different decisions. The final and most damaging mistake is delay. The belief that things will stabilize later leads to inaction, but financial systems compound quietly. 10 years of suboptimal structure cannot be undone quickly. The conclusion is straightforward. The discomfort felt at $100,000 is not proof that the income is insufficient. It is evidence that the default decisions attached to that income are unsustainable over time. Change the decisions, and the same income produces a different outcome. The solution is not radical. It does not require extreme frugality, high-risk investing, or a dramatic increase in income. It requires restructuring how income is assigned before it is spent. The core shift is moving from lifestyle-driven cash flow to system-driven cash flow. The central principle is this: fixed costs must be capped first, not adjusted later. Most households do the opposite. They earn income, spend on major obligations, and hope what remains is enough for savings and flexibility. The order needs to be reversed. The first mechanical step is setting a hard ceiling on non-negotiable expenses. Housing, transportation, insurance, and debt payments combined should ideally remain below 50% of net income, and in higher cost regions, no more than 55%. This is not arbitrary. Below this level, households retain enough margin to absorb shocks without debt. For a household taking home $6,000 per month, that means fixed costs capped at $3,000, $3,300. If current obligations exceed this, the solution is not cutting groceries or entertainment. It is restructuring the largest line items over time: housing choices, vehicle financing cycles, and debt duration. These changes are slow but durable. The second step is separating money by function. Instead of one general checking account, income is divided immediately into three categories: operating expenses, protection, and long-term capital. Operating expenses cover monthly life. Protection includes emergency savings and insurance buffers. Long-term capital is retirement and investment. This separation is mechanical, not emotional. For example, 15 to 20% of net income is automatically directed into protection and long-term capital before discretionary spending occurs. If income fluctuates, discretionary spending adjusts, not savings. This reverses the typical failure pattern. The third element is liquidity discipline. Emergency funds are not optional. A stable system requires at least 6 months of core expenses held in liquid, low-risk accounts. This buffer prevents forced debt use and protects investments during downturns. It is not designed to generate returns. It is designed to preserve decision-making freedom. Once liquidity is secured, investing becomes stable rather than stressful. Contributions are consistent, modest, and long-term. No attempt is made to time markets or chase returns. A diversified portfolio with regular contributions benefits from time, not prediction. Stability comes from consistency, not complexity. Importantly, this approach reduces risk rather than increasing it. Lower fixed costs reduce exposure to job loss. Liquidity absorbs shocks. Automatic allocation prevents behavioral drift. Over time, the system becomes self-reinforcing. Consider two households earning $100,000. One maintains fixed costs at 65% of net income, saves irregularly, and reacts to surprises. The other caps fixed costs at 50%, saves 20% automatically, and holds 6 months of liquidity. After 5 years, the second household has flexibility. The first has stress. The income was the same. This is not about restriction, it is about control. When cash flow is structured deliberately, income works harder without increasing effort. The solution is stable because it relies on margins, buffers, and consistency, not optimism. 6 figures can support security, but only when the system is built to protect it. At this point, the picture is clear. The problem was never that $100,000 is a bad income. The problem is that modern middle-class life automatically converts that income into rigid obligations unless a deliberate system interrupts the process. What feels like poverty is, in most cases, loss of margin. The full system can be summarized in 3 layers: limits, separation, and time. First, limits. Fixed costs must be capped before lifestyle decisions are made. Housing, transportation, insurance, and debt are not neutral choices. They define how resilient the household will be. When these costs stay below roughly half of net income, the household retains optionality. When they exceed it, stress becomes structural. This single constraint determines whether future decisions are proactive or reactive. Second, separation. Income cannot remain pooled if long-term outcomes matter. Money must be assigned roles immediately. One portion maintains daily life. One portion protects against disruption. One portion builds future capacity. This is not budgeting in the traditional sense. It is a cash flow architecture. When savings and investing occur automatically, they are no longer dependent on discipline or optimism. Third, time. Financial systems work because they compound quietly. Small, consistent actions dominate occasional large ones. Stability improves not in months, but in years. The timeline matters. After 1 year, the primary change is not wealth, but control. Emergency reserves exist. Credit dependence decreases. Financial surprises no longer trigger panic. Decisions feel slower and more deliberate. After 5 years, the difference becomes visible. Investment balances grow meaningfully. Career choices widen because the household is no longer locked into maximum income dependency. Risk tolerance improves, not because risk increased, but because downside exposure declined. After 10 years, the outcome is structural. Net worth separates sharply from income peers. Fixed costs represent a smaller percentage of cash flow. Income becomes a tool rather than a constraint. At this stage, financial stress is no longer constant. It is situational and manageable. The actions required to begin are practical and immediate. First, calculate true net income and fixed obligations. Remove assumptions. Use actual numbers. If fixed costs exceed sustainable limits, identify which commitments are renegotiable over the next 2 to 3 years. Second, establish liquidity. Build an emergency reserve based on core expenses, not lifestyle preferences. This is the foundation. Without it, no strategy holds. Third, automate separation. Direct a defined percentage of income into protection and long-term capital before discretionary spending occurs. Adjust lifestyle to what remains, not the other way around. Fourth, maintain simplicity. Avoid complex strategies until the system is stable. Complexity without margin increases fragility. The conclusion is straightforward. Six figures can feel poor when they are fully committed before they are fully understood. When income is structured instead of consumed by default, its effectiveness changes. The goal is not wealth signaling or acceleration, it is durability. Financial security is not achieved by earning more alone. It is achieved by ensuring that what is earned remains flexible over time.